Okay, so hello everyone and welcome to this webinar on portfolio management in Bourstad simulations. My name is Paul Bourget and I'm the project director of the Bourstad project at CIRANO. In this webinar, you will hear Mrs. Erika Toth, holder of the CFA certification, the most widely recognized investment certification among professionals in the world. Mrs. Toth is Director of Institutional and Advisory for Eastern Canada at BMO Global Asset Management. Hello, Mrs. Toth.
Hi, thank you so much for having me. It's a pleasure to participate.
Would you like to say a few words about you and the presentation you will make?
Sure, yeah. So my name is Erika Toth. I've been at BMO for 13 years now. And for the last 10 years, I've been on our exchange-traded funds team within our global asset management division. And my day-to-day, I consult with portfolio managers across Eastern Canada, helping them put together portfolios. So I consult with them talking about market conditions. I help them understand how to use exchange-traded funds in their portfolios in order to achieve better results for their clients. Using different types of strategies. And the type of clientele that I work with, it's portfolio managers that could be running discretionary assets for retail investors, for example. It's portfolio managers that are running, for example, family offices. It also includes mutual funds, portfolio managers running mutual funds, and also some smaller pension funds in the Eastern Canadian market. So that's a little bit about what I do in my day-to-day. So I've spent the last decade doing that. And in terms of my presentation, I'm going to talk a little bit. So the CFA Society of Montreal and also Bourstad asked me to present on active management tonight and some of the different approaches that exist. So when you see the choices in the platform, you might have a better understanding of what some of those choices are and how you can use them within the competition. So my goal is to give a little bit more background on what goes into some of these strategies and how you might be able to use them. So should we kick it off? Should I share my screen?
Well, first, before
you're going to go over, of course, how it's going to work with the contest. Okay, yes, go ahead. I'm jumping the gun.
Okay, so I will describe portfolio management in Bourstad simulations and say a few words about how portfolio management will be evaluated in the 2024 Bourstad Challenge. So let me, yeah, I have to share my screen. In fact, yes, this is not done yet. I share my screen and the presentation is ready to go. So, as I said, I'll be talking about portfolio management in Bourstad simulations. So the investor's profile, the investment strategy, the learning objectives, and how portfolio management is evaluated in the Bourstad Challenge. After my short presentation, Mrs. Toth will make her own presentation about active and passive portfolio management strategies. Okay, so what are the criteria used by the jury to evaluate the quality of portfolio management by contestants? First, the consistency of the fictitious investor. Is this fictitious investor a consistent person? I mean, is that realist? The choice of strategies and how these strategies are consistent with the investor, the transaction that you will carry out according to the strategies enforce what you have defined as the basic portfolio management strategy that you will try to implement. Portfolio management follow-up according to mandatory justification provided. Every time you do a transaction, you have to indicate how your portfolio is modified by this transaction and also to specify some realist objectives about income and capital appreciation linked to this trade. What will be the performance that you will achieve in relation to the investor's objectives and profile? What are your learning objectives, and will you achieve these learning objectives? And how much will you consider responsible investment concepts in managing your portfolio? Portfolio management on the Bourstad platform is based on three functionalities. First, the investor's profile. Who is your fictitious investor? Second, the investment strategy, what is most linked to portfolio management. And finally, your learning objectives. When you issue a buy or sell order on the platform, first you have to select the security, you have to indicate the quantity, and you have to also give figures about how this transaction will modify your portfolio, what will be the quantity L after the trade, and what will be your liquid balance after that transaction, and also how the composition of your portfolio is modified by this transaction. The impact on liquid assets, bonds, utilities, financial services, consumer products, industrial products, natural resources. And finally, you have to specify the income objectives. If you're buying a stock, for example, that would be the annual dividend that you want to receive with this new stock in your portfolio. And what is your goal for capital gain by buying the stock? Both these figures are expressed as an annual percentage. Okay, so the portfolio management functionality of Bourstad includes three functionality. So that's investor profile, portfolio management, and learning objectives and achievement. A fourth functionality is not shown here on the screen, but we call it notes. It's something like a white page on which you can write anything that you believe is relevant to what you're doing in the competition. And consider that both your teachers, if you are a student participating in the school version, and the jury will be able to see what has been written on the note functionality. Okay, investor profile. First, there is a tab about the description of this investor, meaning his age, his or her age, what type of job is this person doing, is there a job security, a weak or high job security, some information about the household, is this investor living with a partner, are there children in the household, what are the income of all these people living in the household. Finally, on the investment information tab, you have to indicate what is targeted as income, what is targeted as capital appreciation. Both these figures are expressed as annual percentages. What is the risk tolerance? Is your investor highly tolerant to risk, or is he or she risk averse? What is the experience about investment of your fictitious investor? Does he know or does she know much or little about investment? What are the total assets, total debt, total annual income? And finally, you have to specify an investor profile, prudent, speculator, or in between, middle. Portfolio management. So you have to indicate first, will you try to beat the market and have a higher return than the market return? And then we would call you an active portfolio manager. Or will you only be trying to achieve the market return? This is called passive portfolio management? Would you be relying mostly on widely available public information? This is called top-down approach. Or will you be looking for, let's say, not so easily found information about the economy, the industries, or the companies you are investing in? And that would be bottom-up approach. How your asset, your $200,000, will be allocated between liquidity, bonds, utilities, financial services, consumer products, industrial products, and natural resources products. What will you be trying to learn by participating in Bourstad? You can specify those learning objectives until the February 25 deadline. And after that, from February 26th until the end of the contest, you'll be able to write learning achievements related to your objectives. Okay, let's say a few words now about how portfolio management is evaluated. First, you have formative evaluation in Bourstad simulation. We're talking about 5 evaluation measures. And at the end of the contest, right after the end of the contest, we will compute a summative evaluation of your portfolio management skills with 14 measures. The formative measures are realism of the investor's situation, the coherence between the investor profile and their risk sensitivity, the coefficient of learning. What are you trying to learn? We're putting a figure exactly on how much you're trying to learn by participating in Bourstad. Strategy versus real portfolio. Is there a gap between the real portfolio and the allocation that you made in your strategy? And what is the percentage of your money that is being effectively invested? Okay, here you look at all the summative measures. Let's mention that this presentation will be made available in the notification system alongside the recording of the webinar. So let's go on and add some more information about many of these measures. First, the formative evaluation, there are 5 of these measures. You can consult the information on the dashboard. You quickly see exactly what you have done, but you have the detailed information in your detailed report. For the summative evaluation, all 14 measures will be available as soon as the contest ends on April 12th. I mean, allow for a few hours before all the computation is done, but very soon after the end of the contest. On the dashboard, you can see here that there is a widget about the achievements. And if you want a specific number about your grade, you click on detailed report and you'll immediately see how you have been graded on all these measures. Okay, let's look at a few of graphs about these assessment measures. Realism of the investor situation. We have identified 6 criteria that are required so we can consider that your investor is realist. Keep in mind that someone has entrusted you with 200,000 Canadian dollars to invest on their behalf. And it's probably not Warren Buffett, because Mr. Buffett just could not keep records on the great number of portfolio manager he would have if his money was allocated by chunk of 200,000 Canadian dollars. It's certainly not Jeff Bezos as well. it's highly improbable that it would be a recent 649 winner, and probably not a college graduate who just got his first job as well. Probably not. How coherent is the investor profile and their risk sensitivity? We have identified 10 risk factors, and if we're talking about a prudent investor, the grades start at 60, and when the number of risk factors increase, you eventually go to 100. If we're talking about an intermediate, in middle investor, the grades start at 100, and for every risk factor, a little is lost. Eventually, if the 10 risk factors are there, you will get a 50% mark. If we're talking about a speculator, the grades start at 100 as well. But eventually, if the 10 risk factors are present, the grade will be 0. Okay. Consistency between the sector weights in the strategy and the investor profile. So we have attributed a weight, because when we start with cash, bonds, utilities, financial services, consumer products, industrial products, and natural resources, in a way, it's a continuum of risk, because natural resources are, as a group, more risky than cash or even industrial product or consumer products. Okay, so what we do, we multiply by 100 all the allocation that you've done about these asset classes, and we are able to attribute marks depending on the investor profile. Okay, let's say that a speculator, for example, would put all his money in natural resources. It would still get a mark of 60. But if that would be done by a prudent, for a prudent and fictitious investor, the mark would then be only 40. Okay, the mark 40% instead of 60. Eventually, it's a mix, it's portfolio diversification that yields the greater marks. Okay, financial performance considering investor profile, it will depend eventually how well the market will perform during the contest. But for 2023, you have a look at what we gave as marks, depending on speculator, intermediate, and prudent. You see that for a speculator, we are ready to attribute a higher mark when losses are incurred, because it's part of being a speculator. Losses are highly more probable then. Okay, average liquid balance maintained during the simulation. You should aim to invest the maximum amount of the sum you were entrusted with. And you can do so because you'll find on the platform many money market funds. And currently, these funds are yielding something like 4 or 5%. Though. So you should certainly take advantage of this situation. But we are not applying a penalty if the average liquid balance is $50,000 or less. Okay, compatibility of additional justification with the fundamental technical profile. A few questions are asked for which there are no good or bad answers about what you'll be doing in your stock selections. Will you be looking at up and downs? Will you be studying moving averages? Will you be studying short-term fluctuations in the prices of these securities? then if you answer yes to all these questions, you certainly have technical analysis bias. But if you're doing more fundamental analysis, you would be calculating, computing financial ratios. You would try to put a figure on the fundamental value of these securities, and you would probably give a look at the projects and the management team of the corporations. So what we do in these measures, we look at the difference from the expected price justification rate according to the bias that you can have. If you are more of a technical analysis type of manager, then you would normally have a lot of justification based on price, but it would not be the case if we have identified the fundamental analysis bias in your portfolio management style. So keep that in mind. Weight of sectors in the portfolio versus weightings in the strategy. So here we can compute a figure about the difference. Normally, the maximum difference would be 200. And if you have a 200 difference between the strategy and the weightings of the real portfolio, you would get a 0 mark. But it's quite close. It's very close. If the real portfolio matches very closely the weighting of the investment strategy, you would get 100% mark. Okay, assessment of the impact of transaction on the weight. Every time you issue a trade, a buy or sell order, you have to indicate how your portfolio will be modified by this very trade. So normally, when you buy, your cash balance will decrease, and when you sell, it will increase. But there is one exception if you're buying or selling a security that is considered 100% liquid asset. Okay, then there would be no change at all. Estimation of the liquid balance after transaction. You have, when you issue a trade, you have to indicate how much money you'll be left with after the trade. So you make a reasonable estimate of your cash balance after a trade order is executed. There is a tolerance of $250. So there's no need to calculate to the nearest dollar. Okay, a look at the deadlines in the 2024 Bourstad Challenge. As you know, it has started on February 12th. Until February 25, by the end of the day, that's not the coming Sunday, but the next Sunday after that, you will have to have recorded the definition of your investor client, the initial portfolio management strategy, and you have to specify your learning objectives. Okay, that's the main deadline that you have to respect as we speak. After that, there'll be the qualification test for the responsible investment component between March 11 and March 24. April 12, it's the end of the simulation. Don't forget to record your self-assessment of what you learned in the simulation. Between April 15 and April 26, Autorité des marchés financiers is launching a call for testimonials about what will be your learning experience. What have you gained as learning experience by participating to the 2024 Bourstad Challenge? Okay, so documentation. There's a lot of documentation on the system. Give a look at the contest rule, for example. Portfolio management in the Bourstad simulation in the documentation, how it works folder. You can also look at assets and average household liabilities based on the census in 2010, documentation et educational content. In French, Revenus totaux des ménages québécois, 2010, documentation, educational content. Also, you can just give a look at the recording of the Basics of Stock Market Investing webinar that was held on February 6th, and the PDF version of the presentation. Okay, so I'm done with my presentation. If there are questions, maybe you can write these questions in the discussion, and then I will invite Mrs. Toth to make her presentation.
Thank you, Mr. Bourget. So I will try sharing my screen now. Hopefully this works. So like I said, my goal was to give you a sense of some of the different types of strategies that are available now in the ETF space in Canada. I mean, certainly things have grown a lot. There's a lot more products now compared to 10 years ago. And you're going to see some ETFs listed as choices for your investments within the platform. So we thought it might be a good idea to talk about what some of the methodologies are in these choices that are available to you. So in terms of the ETF landscape in Canada, over the last 10 years, like I mentioned, it's really grown a significant amount. So 10 years ago, there were just under 300 ETFs available to choose from on the Toronto Stock Exchange. And now it's actually very close to the 1,400 mark. When I joined the BMO ETF team 10 years ago, this past August, there were 6 ETF providers in Canada. Now there are 40. To give you a sense, though, it is quite concentrated in terms of the top largest providers, the asset base. So BMO would be the second largest in Canada. We just crossed $100 billion in terms of assets under management. The top 3 players, which are iShares, BMO, and then Vanguard, account for about 70% of industry assets. And the industry now, as of end of January, is actually past the $400 billion mark. So ETFs are no longer just ways of tracking an index passively and earning index returns, although certainly that is what they started out as. But now, you know, over time and as more products have been launched from different providers, there are ETFs that are, yes, index oriented, but there are also ETFs that are, I'll go over that in a second about the different types of ETFs, but there's also ETFs that are sort of in between active and passive management. And there's ETFs that are fully actively managed in the traditional sense, like, you know, would be associated with mutual funds traditionally. So that's now available in an ETF wrapper as well. So we'll talk about some of the different strategies available. Here on the next slide, I just, I posted, this is from CETFA, CETFA.com. And that's the Canadian ETF Association. And this is the different ETF providers now that have ETFs trading on the market in Canada. So you can see, like I said, the 3 largest ones account for the lion's share of the industry assets there. But a lot of asset managers that traditionally offered active mutual funds are now launching products in an ETF format. So this is an overview of the entire industry, just to give you a sense of some of the different providers available. In terms of a little bit of background on BMO's offering, we do, as the second largest provider, have some of the largest, some of the most liquid and some of the lowest cost products available on the market today. So for example, ZSP, which is our S&P 500 ETF, is actually the largest ETF in Canada out of all the ETFs, and it's also the largest S&P 500 ETF and the most liquid. And it's at a very low management fee of 8 basis points or 0.08%. So we're the largest in Canada in terms of providers when it comes to fixed income ETFs, both in terms of assets under management and in terms of the numbers of choices available. We're the largest manager of covered call or income-oriented ETFs in the marketplace, and we're also the largest manager of factor-based or smart beta ETFs. These are sometimes always also called rules-based ETFs, and this is really the halfway point between indexing and active management. So examples of some rules-based ETFs that you might see, and we'll go over a few of these examples with you, would be dividend ETFs, low volatility ETFs, and high quality ETFs, to name a few. So BMO has, in terms of our ETF business, a track record of innovation. We were the first provider to launch currency hedged ETFs in Canada. We were the first provider to launch discount bond ETFs, to launch high yield bond ETFs. We were actually the first provider of covered call ETFs in the world. So that was definitely a first that we brought to the market 13 years ago here. And we also manage a lot of portfolios of ETFs. So that's a little background on us. Now, in terms of the investment industry flows, I just wanted to shed some light on this in terms of trends we've seen, especially over the last couple of years. This shows investment flows by different types of investment products, and it goes back to 2017. And what's really interesting here is that actually flows of mutual funds were negative over the last 2 years. So you could see the pink and yellow parts of the graph on the right-hand side. ETFs were still positive. It's still a very fast-growing investment vehicle. So that's the green, although it was less positive than it was a few years ago. And the reason for this is simply because a lot of cash was flowing into high interest savings accounts and also GICs over the last 2 years. With interest rates being that much higher, suddenly it became more attractive to park cash and sit on cash. Before there was really, not much reason to do so, but with the interest rates going up, you can see on the right-hand side here, a lot more money flowing into GICs. So the navy blue bar that you can see on the right-hand side of the chart, that is money going into GICs in the retail banking channel. And the gray part is GICs purchased by investment advisors for their clients. So lots and lots of money on the sidelines as a result of interest rates that we haven't seen the likes of in the last 15 years. So I also wanted to show here, I mentioned, traditionally ETFs have been associated with index or passive management. There's been a lot of growth and a lot of different types of strategies now offered. On the left-hand side of the chart, you'll see in the yellow bubbles, these were areas of negative flow. On the mutual fund side is yellow, where they saw the biggest outflows. And the blue bubbles are where ETFs saw the biggest types of inflows. So you'll see standalone ETFs, fixed income ETFs, money market ETFs were very popular in 2013, and passive index ETFs. Active ETFs to a lesser degree. In terms of mutual funds, where they saw the biggest outflows was actively managed ETFs and balanced ETFs. So I think that that's an area where you're probably going to see some shifting towards lower cost product structures there. So I wanted to give a few examples of different types of ETFs available. We talked about index ETFs, so some that you might see on the list, for example, in terms of equity index ETFs. One of the examples is the iShares Canadian Russell 2000 Index, or XSU. That's an iShares product. Maybe you'll see something like the BMO NASDAQ 100 Index, or ZQQ, or maybe the iShares equivalent. In terms of the fixed income space, you might see a lot of BMO ETF products on the list there for your bond exposures, as we are the largest provider in Canada for bond ETFs. A few examples that you might see would be the BMO Short-Term Corporate Bond Index ETF. So this is an index of 1 to 5 year laddered corporate bonds, all investment grade. The BMO Midterm Corporate Bond Index, same thing, all investment grade bonds. And it would be the 5 to 10 year part of the curve. Sector ETFs, there's also a lot of index sector ETFs listed in Canada, and I'll go through this in a little bit more detail after. But examples of this would be XIT, that's the iShares Canadian Tech Sector ETF, so tech companies here in Canada. Also XLV, the healthcare SPDR ETF, which is listed in the United States, for example. So the rules-based or smart beta ETFs, sometimes they're also called factor ETFs. This is really the midway point between indexing and traditional active management. So with these types of strategies, you're using the index as a starting point to filter the universe for stocks with different characteristics than the index. So you have a specific objective. Examples of this would be the iShares Canadian Value Index ETF, the BMO Low Volatility Canadian Equity ETF, ZLB, or or the dividend aristocrats that iShares offers, that's CDZ. So I'm going to give some examples later on in the presentation of filtering rules that these ETFs might use. So that might be helpful to you when you're making your choices. Another area that's grown a lot, specifically in the last 5 years, have been balanced all-in-one type ETFs. So think of the traditional balanced mutual fund. Now these are index-based ETFs, so they hold the different indexes globally, and they rebalance to a set asset allocation. So Vanguard offers them, BMO offers them, iShares offers them. I know that ours are around the 0.18% management fee level and offers you exposure to, for example, the TSX, the S&P 500, the MSCI EFI index, the MSCI Emerging Markets Index. And if it's a balanced portfolio, you might see some of the aggregate bond index for Canadian bonds, the US aggregate index, and maybe some corporate bond exposure there on the periphery as well. And those tend to be rebalanced quarterly. They're great set it and forget it type solutions. Like, for example, for, they're typically used, one example that I like to use is for like smaller accounts that advisors deal with. If it's, let's say, an RESP account for a child that was just born and you have probably 20 years before you might start withdrawing the money, then an all equity ETF solution, and the balanced all-in-ones are quite popular. There's also retirement income portfolios that fall under that sort of all-in-one ETF category. So for example, Vanguard has the VRIF ETF, BMO offers the ZBAL and also the ZBAL.T for clients that need a little bit more cash flow. It pays a 6% cash flow. There's also a lot more actively managed ETFs now compared to a few years ago. So a couple of examples of this. A few years ago, BMO partnered with ARC, the US asset manager, and we actually now offer 3 of their funds on our platform. So ARKK is one example, and that is bottom-up stock picking. They research, like macro trends from a high level. Also, what sorts of technologies they think are going to grow in the future, but they're also researching the companies at the individual level. Another example is the TD Active Infrastructure Equity ETF. And another type of strategy that I'm going to cover here is the covered call ETFs. So these are popular with income-oriented investors, investors that need a higher level of cash flow from their investments, a higher level of tax-efficient cash flow. And a couple examples of this would be the BMO Covered Call Canadian Banks, ZWB, and the BMO Covered Call Utilities ETF, the ZWU. So we'll go into a little bit of that momentarily. All right, so let's talk about the case for index investing. Some of you might be aware of the SPIVA report. SPIVA stands for Standard & Poor's Index versus Active. S&P Dow Jones Global Indexes, that's an index provider, and they actually publish this report 2 times a year, and it shows at what percentage of active managers have been outperforming in each asset class and over different lengths of time. So one thing that I'll highlight here is in the US equity category, portfolio managers are benchmarked against the S&P 500 index, and that is notoriously one of the most difficult indexes in the world for a portfolio manager to beat consistently. So you can see as of this report, over the 10-year period, it was less than 3% of active portfolio managers that were able to consistently outperform the US equity market, the S&P 500. On the Canadian market, though, because we have a less broad market, it tends to be more cyclical. There's actually higher rates of active portfolio managers that are able to outperform the market here in Canada, the TSX, on a more consistent basis. So you'll see that if you go in the top 2 levels of the chart here. So I just wanted to put that into perspective. Also, for example, Canadian small and mid-cap equities, that's actually an area where portfolio managers over the long term, active portfolio managers, are able to add a lot more value versus the index by researching individual securities. So I wanted to talk a little bit more about the idea of rules-based ETFs. These, like I mentioned, they're really the sort of halfway point between indexing and full-blown traditional active management, where you have somebody that's picking the individual stocks and buying and selling on a regular basis, in anticipation of market conditions and certain macro events. So rules-based ETFs are a way that you can either reduce risk versus the broad index or try to outperform the broad index. You're able to gain exposure to stocks with specific characteristics. A couple of examples of these types of screens would be, companies with a track record of increasing dividends over a specified period of time. It might be companies with strong profitability versus their peers, company with low debt, strong balance sheets versus their peers. Those are examples of screens often used in quality factor ETFs, which screen for companies with higher quality fundamentals. It might be a screen for companies that are less volatile than the broad market. These are used in low vol strategies, and measures of volatility that might be used might be how high a stock's beta is. That's how volatile it is versus the broad market. That's the type of screen we use in our low vol strategies at BMO. Some of the iShares ones actually screen for companies with lower standard deviation, which is how volatile a stock price is versus its own price history. So that's the iShares min-vol strategies. Another example is value ETFs, where the screens are based on valuation metrics such as price to earnings or price to book versus that company's peers within its sector. So typically these rules-based ETFs are, they tend to be about half to even a quarter of the cost of traditional active management. And oftentimes the performance has been as good, if not better. So they've gained a lot of popularity over the last few years. I like this chart in the middle of the screen here. I find it helps put them into perspective. So the broad index would be sort of in the middle of the screen in terms of the level of risk or volatility. And as you go to the left, those are rules-based approaches or factors that are less risky than the broad market. So for example, investing with a quality screen, dividends are on the more defensive side of that continuing as well. And the most defensive of the factor ETFs would be the low volatility ETFs. And you would tend to see, more securities in the defensive sectors such as utilities, for example, healthcare and consumer staples in higher proportions in those low vol strategies. To the right of the broad market index sort of risk level that's in the middle, the beta typically is 1 on the broad market indexes. Small cap strategies, for example, tend to be more risky, more volatile than the broad market. Momentum is another one, and actually value tends to actually have a higher level of volatility than the broad market as well. So I'll walk you through a few examples here. So this is an example of the screens that we use on our dividend-based ETFs. So when we're screening the broad market, either the TSX in the case of the Canadian dividend portfolio or the S&P 500 in the case of the US dividend portfolios, what we're looking for is companies that are large and liquid. They're typically mature. They would have, a lot of trading history. So they're typically not new companies, and these ETFs have to be liquid so you can trade them easily. So that's why we have that liquidity screen in place. But we're also looking for companies here with a track record of paying dividends and companies with a track record of growing their dividends if possible. So in order to make it into one of our dividend baskets, any company that would have cut their dividend over the last 3 years is actually not eligible for inclusion. They do not pass the screen. And like I said, we do have a preference for companies that are growing their dividends over that 3-year period. So that is one of our litmus tests in order for a company to be included in the portfolio. We also have a 5-year measure of dividend sustainability because we want to make sure that the companies that we're including in the ETF are less likely to cut their dividends going forward. So we're looking for companies with strong operating cash flows that are able to finance their dividends in a healthy way from their ongoing operations. But we're also looking for companies where their dividend payout ratio is not too high a percentage of their earnings per share. Because if they're paying out too high a percentage of their earnings, then they might be more likely to cut their dividend down the road. So these are screens that we look at. And then we weight by the company's total dividends per share, so on a dollar basis. So that tends to lean towards larger cap companies, and it tends to give the portfolio a higher quality bias as well. So even though it's a dividend portfolio and it's a little bit more defensive, you still have that quality bias there because of these screens. So to give you an example, ZDV is our Canadian dividend ETF. It's a rules-based approach using the rules that I just mentioned here, the screening rules. The yield on this as of a couple of days ago was 4.31%. That is after the management fee, versus the ZCN, which is our S&P TSX Cap Composite Index, which yields 3.37%. So you get a little bit more dividend yield than the index. And some of the top names in the basket, usual suspects, if you're looking at a Canadian dividend fund, you have Royal Bank of Canada, Bank of Nova Scotia, Enbridge, TD, CIBC, BCE, Canadian Natural Resources, Bank of Montreal, Manulife, and CN Rail. On the right-hand side, you'll see our US dividend basket. So in the US, the companies don't tend to pay as high dividend yields as we see here in Canada. So the S&P 500, which is the broad index, only pays a dividend yield of about 1.37% currently. ZDY, which is our US dividend basket, which screens for the criteria that I mentioned, that has a yield of about 2.5% currently. And some of the names in that basket, JP Morgan Chase, Home Depot, you have AbbVie, you have IBM, Johnson & Johnson, Apple, Verizon Communications, you have Chevron, Microsoft, and Bank of America. So these are all large companies, household names that meet all those dividend criteria. So what I want to show you on the bottom of the screen here is how these companies, dividend ETFs compared to the broad market, to their respective broad markets when you're looking at the sector breakdown. So this is something that's important. I saw that it's a criteria and you need to fill that out in your forms online, is the sector exposure. So it's good to know how these types of strategies tend to compare to the index in terms of sector weights as well. So for the Canadian dividend ETF, we do have an overweight in financials versus the broad market index in Canada. Also a little bit more energy, a little bit less consumer discretionary than the broad market. We tend to have more telecoms in the dividend basket, more utilities, and less materials and industrials, for example. If you look at the US dividend basket, we actually have a lot less technology exposure than the broad market. The S&P 500 right now is almost 30% in IT companies. We tend to have more healthcare exposure, more financials in the dividend ETF, more consumer staples. We have less consumer discretionary. So this is just something to be aware of when you're looking at these rules-based factor ETFs, is that the sector exposure might be different from the index. And this is good to know for your contest. Another example, so I touched on the quality factor. This is quality tends to be a large cap growth oriented factor, but it's a defensive growth strategy, slightly more defensive than the broad market typically, because we call it growth with a safety net, right? We're screening for the companies of the best fundamentals. So the three screens that we use in our portfolio, we use the MSCI high quality index methodology. And we're looking for companies that have a track record of higher profitability versus their peers. We're looking for companies with stable earnings growth over time. So you don't tend to see a lot of cyclical companies or cyclical sector exposures here. So high financials, you won't see that in these indexes, by the way. Another criteria is low financial leverage. So low debt to equity companies with strong balance sheets. So the quality strategy might be defined as companies with a sustainable competitive advantage versus their peers. So some of the best companies in the world. So I'll show you the MSCI USA High Quality Index and how it compares versus the S&P 500. So our USA High Quality Index ETF based on this methodology. The ticker is ZUQ, and the ZSP is our S&P 500 ETF. I forgot to put the tickers in here, but that's the tickers. So you'll see the top holdings, the Magnificent Seven figure prominently. So you have Meta, you have Apple, you have Microsoft, you have NVIDIA, you have Eli Lilly, you have Broadcom, Visa, United Health, MasterCard, and Johnson & Johnson, rounding out the top 10. And you'll see that this strategy, based on those screens and the exposures in place, that over 5 years, it's actually outperformed the S&P 500. So this are the numbers as of the end of January, and this is net of fees. The US High Quality did almost 17% on an annualized basis over the last 5 years, versus the S&P 500, which did 14.4%. Over the last 2 years, the annualized return is 10.88% on the US High Quality versus almost 8% on the S&P 500. If you look at the 1 year number, very strong on the quality. Like I said, that's because of the screens in place. We ended up with a higher proportion of the portfolio in the Mag 7 stocks, which really did drive market returns over the last year. So return over the last year of 33.7 versus 21.61. I want to show you also the 5-year risk measures here, an analysis of how it stacks up versus the S&P 500. So it did, like I said, outperform the S&P 500. In terms of the standard deviation, that's the level of volatility, it was fairly similar. But the Sharpe ratio, the Sharpe ratio, which is the risk-adjusted return, was higher in terms of the US High Quality strategy. You'll see that the max drawdown on the right-hand side in the middle of the chart here, there was actually a higher drawdown level when things did go down, because on the quality side, you do have a little bit more technology exposure than the broad index. And you'll recall that in 2022, actually, the tech sector sold off quite a bit. So that would be why you are seeing that. So like I said, more tech in the quality basket than in the S&P 500. You also have more healthcare. You have less consumer discretionary than the broad market. You have more telecoms, and you have more industrials. So that's, some of the comparisons in terms of how it stacks up versus the S&P 500 index and what you need to know. So if you're going to be using any rules-based ETFs that are on the platform, I always suggest looking on the provider's website, whether it be BMO, iShares, Vanguard, or some of the other providers, and understanding what some of the screens are, and also looking at what your exposures are in terms of the sectors and in terms of the names, so you have an idea of what you're holding in the portfolio and how it might do given macroeconomic conditions. So I did mention just briefly covered call ETFs. These are a popular solution with investors who might be retired or semi-retired, clients that might be withdrawing from their portfolios, or perhaps they have a RIF account and they need a higher level of income to meet their RIF account withdrawal needs. So this would be a good way to do that. So the dividend yield plus the options yield, because we're selling options on the stocks within the portfolio to generate additional yield over and above the dividends that we're earning from the companies that we hold. The yield is right now, you'll see on average, anywhere from 5.5%, 6%, 7%, sometimes even 8%, depending on what type of strategy. And typically, half of that comes from the options premiums, which is taxed as capital gains. So even if an investor has to hold it in a non-registered account, it's quite a tax-efficient way to get additional income as well. So this is an area where BMO is by far the largest manager of covered call ETFs in Canada. Like I mentioned, we launched the first covered call ETF in the world 13 years ago. That was ZWB, the BMO Covered Call Canadian Banks ETF. We now have 14 different options, and actually out of our almost 200 ETFs that we offer now, the best performing one last year was our Covered Call Technology ETF, the ZWT. So typically that's not a sector that pays a lot of dividends. It's the 30 largest US tech names, and that with writing covered calls on just under half of the portfolio, we're able to generate a distribution yield of almost 4%. And that returned, I believe it was almost close to 60% last year, just to give you an idea. So it depends, in terms of what the economy is doing, what sectors are outperforming. And we're going to talk a little bit about sector ETFs more specifically in a moment, but this could be a way to generate additional cash flow if your investor profile is more defensive, and if they need liquidity paid out to them regularly and on a tax efficient basis. So just wanted to recap here some reasons that investors might want to use actively managed funds or ETFs. So one reason is to try and reduce risk or to try and outperform the market. They might want to pick a more concentrated portfolio of individual names. They might have a focus on income generation like we just saw. Or for example, on the bond side of things, the investor might want to target a certain level of duration or interest rate sensitivity of the portfolio. Bond ETFs or bonds with longer duration tend to be more sensitive to movements in interest rates, whereas bonds with shorter duration don't tend to be quite as volatile. Or they might want to target a certain level of credit quality. So when the economy is doing really well, for example, high yield or sub-investment grade bond ETFs might do really well. But when you're in more of a risk-off market, you want to look for more government bond-oriented ETFs with a higher credit quality. Now, some investors might prefer to delegate this decision-making process, and they might prefer to have a bond ETF that is managed by a professional portfolio manager. Popular bond managers, some of the biggest in the world, PIMCO is one of them. Fidelity also manages a lot of large active bond funds. We have some at BMO as well. So some investors prefer to delegate that decision and buy an actively managed bond ETF rather than making those decisions by themselves. But some investors on the flip side rather would make those decisions themselves and would rather be tactical. For example, so in the last 2 years, the Fed has been increasing interest rates quite aggressively. So investors who would have gone into short duration bonds or very short duration bonds would have fared quite a bit better than investors that had mid or long duration bond exposures. And you can do that tactical management overlay with ETFs. Actually, it's quite a flexible strategy because they're very liquid and you can trade them on the market. So a lot of investors have started to use them in a tactical sense. And even to the extent of pension funds and asset managers, mutual fund managers who've started including these strategies in their portfolios to give them more flexibility than trading individual bonds, which might not be as liquid and they're not as diversified as the ETF. So that would be my point on this slide that I want to make, is that you can also do your own active management overlay using index ETFs as building blocks and either overweighting or underweighting certain areas of the market given macroeconomic conditions. So a couple of examples here I wanted to walk through. So it's the last couple of slides now. Thank you for hanging in here with us. So I wanted to show you that especially over the last year, over the 1 year period here, if you were in the ultra short-term bond ETF, that's our ZST, you would have done pretty well with 5.34%. But the economy was actually in really good shape. And you can see on the 1 year, actually the floating rate high yield did extremely well. And that is US high yield bond exposure with very short duration. So, when the economy is robust, high yield tends to do well. If you were in the aggregate bond ETF, which is the main bond index here in Canada, your return would have been a pretty low in comparison, 2.63% over the last 1 year. And long federal bonds, which are 100% government bonds, those have a duration of a whopping 17 years, actually fared pretty poorly with rates increasing. So year to date, those are down 6.49%. Over 3 years, quite negative, minus 8.79. And I think if you look at it on a calendar year basis, which I don't have the numbers here, but I believe last year it might have been down 26%. So like I said, if you take on longer duration bonds, you have more interest rate sensitivity. So if rates are dropping, that might be great, but if rates are rising, it could be quite painful. So just something to keep in mind, but you can make these decisions and do active management by choosing a particular bond ETF exposure based on macro conditions. Another thing I wanted to touch on here, hold on. Oh, okay. Yeah. So we talked about this one as well. I talked about the MSCI USA high quality for stocks. That's a rules-based or a factor ETF. I talked about how it compared versus the S&P 500 and what some of the screening rules were that are used in that portfolio. I also wanted to compare that versus the low vol US equity ETF, the ZLU that we have. So that, like I said, is the most defensive of the factor ETFs. In down year like 2022, that tends to do really well, the low vol strategies, if it's a risk off market. So for example, in 2022, we saw the S&P 500 was down, I believe it was around 12 or 13%, while the low volatility strategy that year, the ZLU, was actually up 8%. So in a risk off market, typically these types of strategies do really well. But over the last little while, with things dominated by the Magnificent Seven and the tech sector really driving the majority of the returns of the equity market in the States, the low vol strategy has lagged quite a bit. If you're looking at year to date, it's up 229 versus 11% on the quality and 7% on the S&P 500. If you look back, the last 1 year period, 1.41% versus almost 40% on the quality and almost 25% on the S&P 500. So the divergences can be quite big in shorter time periods. So it's important to really understand what the methodology is, what the screens are, and what the resulting sector exposures and securities held in the portfolio are. So that you can access on the website of the providers. I know that the three biggest ones, iShares, BMO, Vanguard, we post daily holdings. So you can see everything that's in that portfolio as of the previous business day's close. So I think transparency is another big advantage of ETFs for investors. So it's not just the lower fees, it's also the transparency, and what you're owning at any given time. So that was, I had the sector slide. Hold on, let me just go back. Sorry. So I also wanted to just touch on this. I briefly talked about some sector ETFs. I mentioned, you can also do your own active management overlay using index ETFs as building blocks. You can overweight or underweight certain areas of the market given macro conditions. So this is actually from one of our white papers, and we give some examples of certain sectors that you might want to overweight or underweight in different parts of the business cycle. So for example, right after a big sell-off, after a recession, when you're in the early recovery phase, typically sectors like financials, consumer discretionary, and real estate tend to do really, really well. When you're sort of mid-cycle, industrials, technology, communications tend to do well. When you're more in the late cycle phase, when things are getting very frothy, typically the sectors that do well at that point in the cycle would be energy, materials, also the agriculture sector. When you're in a recession, though, it's those really defensive type sectors that tend to do really well. So here we're talking about healthcare, because if you break your leg or if you need surgery, it's the decision of, is there a recession right now, is not going to play into that decision. You're going to do what you need to do to fix your broken leg or to have heart surgery. Consumer staples is another example. So you're not going to stop buying toothpaste or face wash or shampoo if there's a recession. Utilities is another thing. Keep the lights on regardless of what's going on in the economy. We're still going to have to heat our houses here in Quebec. So these are examples of different sectors that you can rotate with, and you can do an active overlay and add alpha to the portfolio. And also, you had that sort of sector exposure checklist on your forms there. And so these, with these, you're diversifying your risk rather than holding one company. You're holding a basket of companies in that same sector. So you're not tied to, whatever happens to a particular company, but it's more of a macro play on that sector while diversifying the risk. And you'll have a pretty clean allocation, and you'll know, how much you're holding of that sector. So this could be an easy way to do that. So that is actually it for me. I don't know if there are any questions that came through. I'm happy to answer any questions that you guys might have. I'll stop sharing my screen there.
Okay, but thank you, Mrs. Toth. Maybe I can ask you a question just to conclude. So you mentioned that by using index ETF, someone could, in fact, be doing active management. But maybe an additional question that I can ask you: can an investor that want to apply a purely active portfolio management strategy learn something by knowing more about the ETF world? As I believe that you sort of covered the question, but maybe you could give a short answer to the question. Someone that want to pick the securities,
stocks.
to
Sure,
pick stocks, to build his own portfolio, what can he learn by learning more, by knowing more about the ETF world?
Well, I think if you're an investor that is actively picking your own stocks, you'll have a sense of your style that you're investing with. Are you more growth oriented? Are you more value oriented? What types of screens do you use? And then you might want to even compare that to an ETF in the category. So if you're more of a value or a dividend investor, you might want to have a look at, okay, what's in those dividend or value ETFs, and compare it to your own process, and maybe compare your performance against them. That could be a good way to use the ETF to measure yourself as a benchmark and see how you're doing. Because it's one thing to compare it to the S&P 500, but if you're a dividend investor, if you have a yield objective, then maybe the S&P 500 is not the right comparison benchmark for you. Conversely, if you're a growth investor, and if you are primarily choosing stocks in the US equity market, then you might want to benchmark yourself against either the NASDAQ 100 if your objective is total return, or maybe even the US high quality as an example. So that's a way that even active investors can use ETFs as information and to measure their own performance. They might also want to look at flows of ETFs. And I know that on our ETF dashboard, you can see where the ETF flows have been going, and it'll give you an idea of market sentiment, whether things are more bearish or more bullish, and that can help you choose also what types of stocks or bonds you want to own in your own portfolio as an active investor. Even if you're buying individual stocks or bonds, that's another way that ETFs can provide information and guide asset allocation, even if you're purely active investor that chooses their own securities.
I suppose that maybe looking at what you call the rules-based ETF could maybe provide some cues to those active portfolio managers. Looking
that
at what,
as well, yeah.
Well, sure.
Yeah, it can give some ideas, and some people might want to use it as a contrarian indicator too, right? Like if you're more of a contrarian investor, you might want to, and if you think the market is gonna reverse trend, like that could be a way to look at it also.
Okay, so I'll share my screen again just to go through the last portion of the presentation. So thanks again, Mrs. Toth, for
It's always a pleasure. Thank you.
Your presentation. And question and answers, in fact, is saying that we don't have any. So Mrs. Toth was doing the presentation this evening, and I want to thank her again for the very instructive presentation that she did. And at CIRANO, we had the contribution of Mrs. Émilie Grange, which is the events coordinator at CIRANO, and also Mrs. Elina Caron, our communication coordinator. And I want to thank all those who attended the second webinar of the 2024 Bourstad Challenge series, and also thank those that will watch the video recording of the webinar. So thanks everyone, and have a good
luck
Bourstad
in the
Challenge.
competition.
Good luck in the competition. That's
Thanks.
right.
Have a great evening. Take care, everybody. Thanks for having me.
Bye now.